Hi, students. A very good morning. Welcome to the day two of marathon. Yesterday we had done good amount of problems and quality problems. We did, questions from the past exam, and everything was good enough. So let's get started with capital structure. Today we'll be doing the rest of the topics, and capital structure is the first topic that I would like to choose. So let's dive deep into the concepts. So we're going to have conceptual understanding here. So it's not about how many problems we solve, it's about how well we solve the problems that we're doing. So I am going to touch upon every single topic that is there in every chapter as much as possible so that we're not missing out on anything. Okay. So now capital structure. Yesterday, having done capital budgeting and cost of capital, in capital structure, what are the things that we should take care of? So, one of the things that we should take care of is we get introduced to the basics. That is, what is the value of firm? What is the value of firm? It is very simple. The value of debt plus value of equity. All right. So, next, there is a formula wherein KE is equal to earnings available to equity shareholders divided by value of equity is, the formula that we have learned. In regular class, we have derived this as well. So now we not have much time for it. So I'm just going to go ahead. But I'll just give you a quick, way how to remember it. See, KE, yesterday in cost of capital, we've seen the formula is EPS over MPS. Okay. Okay. In simple words, MPS is, say, for example, 40. That is the market price of my share, my company's share. And earnings per share is, say, for example, 4. Okay. So this is the cost to the company because I need to pay 4 while 40 is the price at which my shares are trading. Right. So I need to pay 4 to the shareholders while 40 is the price at which my shares are trading. Okay. So that is why the cost of the company, EPS, is the cost to the company. So out of 40, you need to pay 4. Something like that I want you to imagine. KD also very similar to that. Interest is my cost. Okay. Net proceeds is what I get. Right. So the cost that interest is what I need to pay and net proceeds is what I get. So this is how you can basically remember them of the formulas logically without even, memorizing them. So I have something more to tell here. Now, KE is equal to what? EPS divided by MPS. We all know that. This is per share, right? So when I now multiply the numerator and denominator by the number of equity shares, I repeat that once again. When I multiply the numerator as well as the denominator by the number of shares, what do I get? We all know that EPS is equal to earnings available for equity shareholders divided by number of shares. Yes. So which means if I cross multiply, can I say EPS into number of shares is equal to earnings available for equity shareholders? Yes. Just have a quick look at that. So the numerator now becomes what? Earnings available for equity shareholders. And MPS, market price per share, into number of shares, total number of shares, will give me the value of equity, right? That is how I got this formula. So it's very easy to remember from there how this formula has arrived. It's not a very big, rocket science. So yes, so we have all understood how this has come. Now let's march forward to KO. KO as in it stands for the overall cost of capital. KO stands for the overall cost of capital. KE stands for cost of equity. KE stands for cost of equity. EAESH stands for earnings available to equity shareholders. Earnings available to equity shareholders. Value of equity is the denominator in this formula. Okay. Make sure that before every chapter, you have a formula page, right? So you will have a formula page wherein you're writing all the formulas, but we'll never memorize them. We'll try to understand them logically as much as we can. Okay. And you have any doubts in remembering any formula, just get back to me immediately. That goes to the online students as well. So now the KO is equal to what? EBIT divided by value of firm. EBIT divided by value of firm. So very similar to this, I would have derived it in the regular class, but now we are in a marathon class where I cannot afford to, take too much of time for this derivation. So in very similar lines, actually, we'll get this formula as well. That is EBIT divided by value of firm is equal to KO, which is the overall cost of capital. The other formula for value of firm is what? Value of equity plus value of debt is equal to value of firm. Okay. So this much we have all understood. Now, what we need to go about is, so these are the basic two formulas that we have. And when the question really tells you follow net income approach, what are we supposed to do? Net income approach, as in they are asking you to follow EBIT minus interest is EBT, minus tax is equal to EAT, minus preference dividend is equal to earnings available for equity shareholders. They want you to work in these lines. Okay. So don't directly apply the formula. If the question says that you have to stick to the net income approach, that means you need to follow this format, right? So otherwise, marks may not be awarded. So please look out for the question. Have they mentioned net income approach, Anta? Then you have to follow this sequence. Okay. So this much is known to us now. Then, what is the other set of formulas that we need to know? Operating leverage. Students, what is leverage? In yesterday's class, I gave a brief example of what is leverage. So, leverage stands for advantage in dictionary terms. The literal meaning of leverage means advantage. But what sort of advantage are we talking about in FM? Here, we are talking about the risk that we are going to take. Operating leverage is equal to contribution divided by EBIT. This measures the business risk. This measures the business risk. So it depends on the fixed cost. If the fixed cost is huge or the fixed cost is less, yep. So accordingly, the operating leverage would change. And one more thing I would like to say, higher the operating leverage, higher the business risk. Higher the operating leverage, higher the business risk. So why you need to write this along with the formula is that it's not only about application of the formula, right? They might ask you to conclude. So this is how we need to do. And when you understand this conceptually, you need to put less, effort on the theory also. So theory is automatically understood. Okay. So now we'll go to the financial leverage. Financial leverage is equal to EBIT divided by EBT. As in, when you say financial charge, we actually mean only the interest, right? So here the interest is the only difference between numerator and denominator. Yani ki, so it measures what? Measures financial risk. So again, higher the financial leverage, higher the financial risk. So this is something that may be asked. It's not been asked recently, so it's a place where it can things can be tested. So then we have combined leverage. As the name suggests, it is both operating and combined leverage put together, which is operating leverage into financial leverage. So up to this, I taught you about 6 formulas, including the value of firm, then the value of KE and KO, and operating leverage, combined leverage, as well as financial leverage. Okay. But students are thinking only these many formulas are there and they're ignoring the other parts. No. Okay. So I'm, whatever we're discussing now, okay, is going to be the sort of checklist that we have to go through before going to the exam. Okay. So now, the next thing that students, forget to go through is indifference point. Indifference point in the recent exams, it has not been tested, but it is a place where it can be tested because about 10 to 12 years ago, when there was no MCQs, in between there was MCQs, right? So when there was no MCQs, there were descriptive papers, just like how you people are writing now in FM. That time, the indifference point had been asked multiple times. And also, the indifference point is quite frequently tested in the other competitive exams like CA, CMA. So which means you have a good chance that you may get indifference point. Ma'am, what is this indifference point? Many people are by-hearting the formula without knowing what it is. So let us dive into what is indifference point. Indifference point is the level of EBIT at which EPS is the same for two given options or two given plans. Two given options or two given plans. That means, first, those of you who want, you can quickly make note of it. Again, I'm repeating this level of EBIT at which the EPS is the same for two given options or two given plans. Okay. So now, always indifference point may not exist. First of all, let me tell you that. Just like, for example, will you always get profit? No, there is a possibility of loss also. Same way, indifference point, ma'am, always baratta. No, it may not come also. Okay. So what am I trying to tell here? EPS of plan 1 or project 1 is equal to EPS of plan 2. We may get, okay, EPS of one project is equal to another project is maybe possible. And what is that level of EBIT? Okay, so that is what is actually the indifference point. That is what is the indifference point. Okay, and mostly EBIT will be a missing information in such questions. You need to find out the EBIT. Okay, you need to find out the EBIT. Okay, so EBIT will be kept as X. Okay, so the level of EBIT at which the EPS is same under two given options, right? So this is what it is. So EPS formula is what? Earnings available for equity shareholders divided by EPS. Sorry, divided by number of shares under plan 1, because the number of shares under plan 1 may be different from the number of shares under plan 2. How? In the first option, I'm considering only equity. In the second option, I'm having debt and equity. In the first project, there is only equity. Okay, I want 20 lakhs. Okay, the first option is I'm raising the full money through equity. Assume the face value is 10. That means 2 lakhs is the number of shares. Okay. In the other option, earnings available for equity shareholders divided by number of shares only. Or EPS formula is not going to change. But EPS will be number of shares of plan 2. The denominator will be number of shares of plan 2. I need 20 lakhs. But I am financing 50% through debt and 50% through equity. So debt, I'll not consider now because I'm talking about number of equity shares. So this is 10 lakhs and this is 10 lakhs. So equity shares of rupees 10 means I need number of shares will be 1 lakh here in the option 2. So that is what we are trying to equate. So I hope now it is very clear to all of you. So the number of shares under option 1 and option 2 may differ. So accordingly, you can keep EBIT as X and equate both the options. Okay. So how you will do this? Earnings available for equity shareholders. Just have a quick look at what I have written here. This is called as the net income approach, right? So we started from where? We started from EBIT and we landed in earnings available for equity shareholders. We're going to use the same concept now also. How are we supposed to do that? Just have a look at it. EBIT minus interest minus tax minus preference dividend divided by number of shares of plan 1 is equal to EBIT minus interest minus tax minus preference dividend divided by number of shares of plan 2. So it's basically identifying, you're analyzing the capital structures. Indifference means what? Indifference means कुछ फर्क ही नहीं है. Now, for example, you like dairy milk also, 5-star also. If you get dairy milk also, you're happy. You're equally happy even if you get 5-star. So the same way here also. Okay. So indifference point means it is the same level. It is the same level. Oh. Now, many students, after finishing the first round of learning, they ask me, what is capital structure? That is so very important, right? So what is capital structure? Debt, equity, preference shares, retained earnings. What combination of this is actually helpful for your business? For some businesses, only equity is good. For some businesses, debt and equity may be good. So all our discussion in capital structure is around this, okay, selection of capital. Okay. So how much is the debt or equity that we require and so on. So this is what is the indifference point. Okay. So now the next is going to be financial break even. Financial break even point. This also some people are missing to read because there's only one mention about it in the ICSI textbook. So, but it could be asked. So, what is a financial break even? It is the EBIT just enough to pay interest, tax, preference, dividend. That means earnings available to equity shareholders is equal to zero. But I'm having money for, I didn't make loss. I'm having money for interest, tax, and preference dividend. That is called as financial break even. Correct? No? Why? Because I am just break even means what? No profit, no loss is what we have in our mind. Okay. So now, here I'm having just enough money to pay my interest, tax, and preference dividend. Okay. So once again, I want all of you to just look at this. The order. So first we will pay our interest, then tax, then preference dividend. So I'm having only that much profit. That is what is financial break even. So say for example, I'm having 10 lakhs. Okay. Interest is 2 lakhs. 1 lakh is tax. Preference dividend is 7 lakhs. So I'm just having enough money. So this 10 lakhs is the financial break even point. 10 lakhs is the financial break even point. Okay. So again, it is the level of EBIT at which earnings available to equity shareholders is equal to zero. Okay. So I'm not diving more deep into this because we have multiple concepts to discuss, but what is the formula? So this is the concept. Formula is going to be interest plus preference dividend divided by after tax rate. Okay. So in the ICSI material, when we solved, we have discussed that there is a small printing mistake. Yes. But please be aware of it. I'm telling for students who have not paid attention at that point in time or who have missed the class. So interest plus preference dividend divided by after tax rate. This is the formula. Okay. This is the formula for financial break-even point. Okay. So there is a question in ICSI material. Please do solve it for indifference point also, for financial break-even point also, based on what we have discussed now. So there is a good possibility that there is printing mistake. If you're having an old edition for financial break-even point for the question that is given in the textbook, but please don't worry about it. Just apply the formula. And indifference point is correct only. That problem, there is no mistake. So please do these two problems based on our explanation. Okay. So now I think so now we have what is called as the Hamada equation. So the Hamada equation in one exam, it has come for a theory as a theory question. I'm talking about the recent exams, okay, the recent 5 exams. Within that time, the Hamada equation has been asked as a theory question. Some of us don't even know from which chapter it is, isn't it? Okay. So now it is from the chapter capital structure. Okay. So now, what is this Hamada equation? First of all, I will tell you what is the formula and I'll just quickly explain what it is all about. So beta levered is equal to beta levered is equal to beta unlevered into 1 plus 1 minus tax rate, 1 minus tax rate divided by debt, sorry, into debt by equity, into debt by equity. This is the Hamada equation. BL stands for levered beta. BU stands for unlevered beta. Unlevered beta means beta without debt. Levered means what, ma? Debt. Unlevered means no debt. That's all. Levered means debt. Unlevered means no debt. Okay. So this is the equation. Okay. So I'm just giving you a basic of it. So just go through this. Okay. You can try to solve one problem in this. I'm just giving you a checklist of what and all you should not be missing out. And what is this exactly? Now, why should I take beta unlevered? Now, what is beta? So now, beta stands for risk. Okay, beta stands for risk. Now, I'm eliminating the risk in this equation. I'm saying I'm eliminating the risk without debt, and I am saying what is the cost of capital. If I eliminate the business risk, then what is the cost of capital? So this is what it is. So basically, it isolates business risk and financial risk. Okay, it eliminates business risk and financial risk. Why do we say that? Unlevered beta nulli, there is no interest. Interest is a financial risk. We have all discussed it where in financial leverage, just now we discussed it. Okay. So then it helps in, computation of cost of capital. Rather than saying cost of capital, computation of cost of capital and analyzing cost of capital, it is helpful. Okay. So once it was asked as a practical problem also, once it was asked as a theory question also, Hamada equation. It is a good possibility that students are missing out on this. So just give some attention to this. And yesterday also I wanted to discuss, but I have reserved it for today. What is it? It is CAPM. The full form of CAPM is Capital Asset Pricing Model. Again, I'm repeating, full form of CAPM is the Capital Asset Pricing Model, wherein we calculate KE. KE stands for cost of equity. Cost of equity, already we learned three formulas. That is DPS divided by MPS, DPS divided by MPS plus G, that is D1 divided by P0 plus G, or EPS divided by MPS. All these formulas we had. Okay. KE is equal to RF plus beta times RM minus RF, where RF is nothing but risk-free rate. You can call it as government rate, treasury rate, because in the US they call the government as treasury, for referring purpose. So it can be called as the treasury rate or the government rate. And then RM is the market risk. And one thing I want you to be very careful about is RM minus RF is the risk premium. Please write it down. If they say risk premium, they have already given you RM minus RF. Don't do RM minus RF again. Risk premium andre RM minus RF. Okay. All right. So then what is beta? Beta stands for systematic risk. The risk that cannot be eliminated. The risk that cannot be eliminated by diversification. That is, say, for example, because of the war, there is a business risk that you're facing. That is a systematic risk. You cannot diversify that risk. All right. Government policy, tax rate changes, all these are examples for systematic risk. Okay. So, of course, in regular class, we explain it even more, but we'll stick to this because we need to revise the other concepts as well. So now, this beta, it could come as a theory question as well. So how can they ask you? Explain what is a beta, or explain the capital asset pricing model, or they could also ask you as to what is systematic risk. Explain about that. So pay some attention there. So all this is taken care of. So what is the checklist that I want you to have? The first three questions of the ICSI material has very good questions on net income approach. So I would like all of you to solve that. Okay. So net income approach, so definitely you should know. Then value of debt, value of equity, value of firm. Whatever I taught you now, those formulas and its application must be known. Okay. So then we need to know about the Hamada equation. I'm just writing in no particular order. I'm just writing the checklist. That's all. And then financial break-even point. Then we also need to know about the indifference point. So there is question for all of them in your textbook. Hamada equation also question is there. Financial break-even point also question is there in the textbook. Indifference point also question is there in the textbook. Okay. So then next is CAPM. You can cover it here or in cost of capital or in dividend. It is a very important one because it is repeated in almost 3 to 4 chapters. In security analysis, also CAPM will be there. CAPM will be used in capital structure also. CAPM will be used in cost of capital also, dividend decisions also. Slightly important. Yes, these are the ones that of course, KE, KO computation you need to know. Okay, that is also part of point number 2, but just telling you. So this is the checklist that you should have for capital structure. The basic concepts I'm saying, apart from theory. So you need to really know about these things before you go to the exam. In today's class, we'll cover some good conceptual problems. So, and then we shall proceed. Now, it's not relating to capital structure, but what I would like to explain to you is in June exams, RSI, the relative strength index, is frequently tested. It is from security analysis, that chapter. Today, I will be solving one problem on that RSI, relative strength index. And one more is the reorder level, average level, minimum level, maximum level. This is also like a little bit frequently tested in the June exam. So please pay attention to these two. Okay. I'm not saying that this exactly will be asked or anything, but there's a good possibility that it can be asked. So cost of capital can be a little important in that manner. So dividend decisions also frequently at least one 5-mark question is coming. It's quite simple to crack it also. So specific to June exam, so I thought I will share it with you. Obviously, this is from working capital management. Today we'll be solving these two. Both problems we'll be solving. Okay. So let us get started with the I want you to solve another question. Where is that gone? Just give me 1 minute. I want to start with this. Anyway, Okay, we'll do this problem first. From the following data of Abhishek Limited as on 30th September, compute the operating leverage, financial leverage, and combined leverage, and percentage change in EPS if the sales are expected to be increasing by 5%. Okay. EBIT is given to us, EBT is given to us, fixed cost is given to us. Past exam question. This is asked about many years ago, but I thought it was a little above. Now, what and all we need to calculate? Operating leverage, financial leverage, combined leverage, and the percentage change in EPS. So there are four things: operating leverage, financial leverage, combined leverage, and percentage change in EPS. All these things they have asked us. Sure. Let us see how we need to go about it. Okay. So operating leverage is equal to what? Contribution divided by EBIT. It measures business risk. Very nice. Okay. So now what and all is given to us? EBIT is given to us. Fixed cost is also given to us. Okay. So now I would like you to recall the marginal cost sheet that we learned in yesterday's class. I'll write it again in case you people have forgotten. So sales minus variable cost, we'll get contribution, minus fixed cost, we will get EBIT. Now we will go in the reverse order because EBIT and fixed cost both are given to us. EBIT is 10 lakhs and fixed cost is 6 lakhs. Okay. 10 lakhs, 6 lakhs. So what is, contribution? So it will be 16 lakhs. I hope everybody has understood. So contribution has found in the reverse direction. EBIT plus fixed cost. Okay. So which means it is going to be contribution is 16 lakhs divided by EBIT is 10 lakhs. Yes. So 1.6 times, right? 1.6 times is the operating leverage. Okay. So EBT is already given to us. So let us write down. So operating leverage is done. That is what they asked first. Then financial leverage. What is the formula? EBIT divided by EBT, which is going to be what? EBIT is 10 lakhs. EBT given in the question, that is 4 lakhs. 2.5 times. So we have done operating leverage and financial leverage. Let us now start combined leverage. Shall we? Yes. Combined leverage is equal to what? Operating leverage into financial leverage. So that is equal to 1.6 into 2.5. So already we got 1.6 and 2.5. We just need to multiply them. How much are we getting? 4 times. Okay. That is the combined leverage. So now we will proceed to the last one, that is percentage change in EPS. It is a very simple thing. Combined leverage, what is the formula? The other formula. Percentage change in EPS divided by percentage change in what else is given to us? Sales. So both are given to us. One needs to be found out. Combined leverage we already know. So it is very simple. Let us see how we need to do. So combined leverage, just now we found out, here it is 4 times. So 4 is equal to percentage change in EPS is what they want, divided by percentage change in sales is given to be 5%. Given. Where is it given here? Yeah. So which means when we cross multiply, we will get percentage change in EPS is equal to 20%. That is the answer. So this is also done. Quite a simple problem. I wanted to do a net income problem somehow that's skipped in the PDF. So let us see how we need to. So let us write the question down and I'll include it in the PDF. Okay. So since it's a past exam question, I don't want to not do that. So I just downloaded this. We'll use it from here. It will be included in the PDF. Don't worry about that. It will be included in the PDF. So this is the problem. So it's a past exam paper. From there, we are going to do this. So I found this question to be good in terms of net operating income approach. So it's not asked recently, but it's asked long time ago. So let's do this. Rutamax Limited and Butamax Limited operate in the same risk class and identical in all respects, except that Rutamax Limited uses debt financing while Butamax does not opt for debt financing. That means one is using levered, another one unlevered. Okay. So now you can immediately, yes, connect to the Hamada equation now. All right. Rutamax Limited has rupees 25 lakhs debentures carrying coupon rate of 10%. That means the interest rate is 10%. Both companies earn 20% profit before interest and tax on their total assets of 50 lakhs. So that means they are saying the EBIT, profit before interest and tax, is 20% on 50 lakhs. Okay. Assume perfect capital markets and rational investors and so on. So the capitalization rate is going to be 15%. Tax rate is 30%. Okay. You're required to find out the value of both the companies according to net income approach and net operating income approach. This is why I was insisting that we should do this problem. Other problems you people can manage. So the problems which are a little bit unique and which needs explanation has to be done here. What is it? Why is it unique? They have mentioned it is net income approach. We have solved in the class. It's there in your ICSA material also. Yes. But when they have said this, you have to stick only to this net income approach and you have to follow that. Okay. So now as we proceed, I'll discuss the other things. So net income approach or net operating income approach. So we have two companies, that is Rutamax and Butamax. So now we will start with EBIT. EBIT is given in the question. It will be included in your PDF. Don't worry. The EBIT is 50 lakhs and it is into 20%. EBIT is 50 lakhs into 20%. Okay. So which means it is 50 lakhs into 20%. That is going to be, yes, dears, 10 lakhs. All amounts are in rupees. Okay. So the next, what we should do after EBIT? Interest, of course. Very nice. In that, one company is not having interest at all. Right. So there is no debt for one company. Okay. So now let us see. I'll erase all the markings now to explain further. Listen very carefully. These type of questions, I'm expecting that it may come. Okay. Well, now Rutamax has 25 lakh debentures and the coupon rate is 10%. So interest rate is 10%. What about Butamax? Butamax does not opt for debt. No debt for Buta. All right. So it is going to be 25 lakhs into 10%. That means 2 lakh 50,000. And here I will write nil. And here I will write nil. Okay. What do we need to find out, everyone? Please keep that in your mind. We need to find out the value of the companies. Value of the company is the same as value of firm. Very nice. Value of firm. That is why we discussed all the formulas now. Okay. Now please help me out with the EBT calculation. So this is 7,50,000 and this is 10 lakhs. Sorry. Hmm. Obviously, next what we should do is minus tax. So, what is the tax? They have given that the corporate tax rate is 30 percentage. Tax at the rate of 30 percentage. So all of you please do this. This 2,25,000. Okay, dears. Thank you. It is 3 lakhs. Okay. EAT is going to be what? Yes. 525. Okay. And 7 lakhs. Thank you, dears. So EAT is also done. So, ma'am, why are you doing all this? Because value of debt, how you have to think in the exam. Value of company is equal to what? Value of debt plus value of firm. So value of equity. Sorry. Once again, I'm repeating. Value of company is nothing but value of firm. That is equal to value of debt plus value of equity. Okay. Value of equity is what? Yes, earnings available to equity shareholders, then divided by KE. Remember everyone? KE is equal to what? Earnings available to equity shareholders divided by value of equity. That means while cross multiplying, can I not say value of equity is equal to earnings available to equity shareholders divided by KE? Yes, we can say that. So if I do this, then I'll get value of equity. Value of debt is already given in the question. Can I not find out the value of firm? That is value of company. That is what is my net income approach. Yes, very similar to what we have done in the study material while we were doing the regular class. So now, those of you who want directly, you can write it is only earnings available to equity shareholders. Those of you who want, you write this. EAT minus preference dividend is equal to earnings available for equity shareholders. In this question, preference dividend is zero. Nothing is given. That is why EAT, whatever is EAT, that will be equal to earnings available for equity shareholders. If preference dividend is given, you will subtract it. Just give me one minute. 'So now, the sixth point is going to be earnings available to equity shareholders given. KE. KE is also given in the question. I'll show it to you because you don't have it in your PDF. It is 15 percentage. Equity capitalization rate or cost of equity is 15 percentage. Now, we all know this formula. Today morning also we discussed. So it is going to be what? Value of equity is going to be earnings available to equity shareholders divided by KE. Just now also I discussed. So 5,25,000 divided by 15 percentage. Please the order of value. So 35 lakhs. Okay. 7 lakhs divided by 10 percentage. 46 lakhs 67,000 66,667. Now, value of debt given in the question. We have given the value of debt, isn't it? Yes. Good. So it is going to be 25 lakhs only for Ruta. There is no debt for Buta. All right. So 25 lakhs. And this is nil. Now we all know value of firm is equal to value of debt plus value of equity. So value of firm is value of debt plus value of equity. It is equal to 60 lakhs, correct? And 46 lakhs, 66,667. So this is what they have asked us to calculate. We have calculated. So it's not a difficult question and all that. Just to understand and apply in the net income approach, I wanted to do this past exam question. Okay. So quickly make note of this and then we will proceed. Just reduce it so that you everything is visible in the same screen. Yes. Yes. Good job. Now we will proceed with so net income approach I wanted to do for you. So now we will proceed to our questions. So we can do this problem. Digi Computers is the manufacturer of a computer systems. Okay. So the company is marketing its products in domestic as well as in global markets. The total sales is given to us. Variable and fixed cost is also given to us. It has borrowed 60 lakhs at 10% per annum and has an equity capital of 75 lakhs. Okay. So now what and all is given? Variable cost, fixed cost is given. Debt is given. And equity is also given. Okay. So now, what is the company's return on investment? So first of all, return on investment. This has a mention in the security analysis also. So there can be a combined question on certain concepts. That is why I've given this. So what is return on investment? Return on investment means EBIT divided by capital employed. Ma'am, how do I remember this? Very simple. What is return on investment? Return divided by investment. Correct? I invested 10 lakhs. I got 1 lakh. So my return on investment is 10 percentage. So investment is only capital employed. Yes, ma'am. Return means what? Profit. That is your EBIT. Very simple to remember, right? So EBIT divided by capital employed. So let us see how we need to do this. So what is EBIT? So again, I'm saying first I will do this first part, that is return on investment is equal to EBIT divided by capital employed. EBIT is equal to what? Let us understand. They have given sales. They have given variable cost and fixed cost. Let me tell you how to find it out. You all know it already. Sales is 1 crore given in the question, minus variable cost is given to be what? 60 lakhs. Contribution is equal to 40 lakhs. Minus fixed cost is given to be how much? 10 lakhs. That means EBIT is equal to 30 lakhs. So we all know this very clearly. Okay. Now, EBIT we found out. How to find out the capital employed? Capital employed is equal to debt plus equity. That is 75 plus 60. Yes, 135. So it is equal to 135. So again, I'm repeating. Return on investment is return divided by investment. Return means what? The profit that we are getting from the business, what how much it is returning to us. The capital employed is the amount of capital that we have put for the purposes of capital structure. Unlike financial accounts or corporate accounts, we will take debt and equity into consideration. You all know that. So that is why 75 plus 60, 135 is the capital employed. EBIT, just now you people saw it was 30 lakhs. So it is going to be 30 lakhs divided by, I'll write like this, 30 lakhs divided by 135 lakhs. How much is that? 22.22. Right, yes. Thank you. 22.22 percentage is the return on investment. So this is done. Okay. So, ma'am, where have they, mentioned about return on investment and capital structure? We have discussed about this as a casual part of theory in security analysis also. So, you may, in security analysis, we know that certain ratios are also discussed. So, it may be asked together. Then, does it have a favorable financial leverage? Okay. So, first of all, let us find out what is the financial leverage, and then we will, comment whether it is favorable or unfavorable. Financial leverage is equal to EBIT divided by EBT. Okay. Now, EBIT we know, just now we calculated that was how much? 30 lakhs. Okay. What is the interest? If we know that, we can find out the EBT also. Debt is equal to what? 60 lakhs at the rate of 10 percentage. That means 60 lakhs into 10 percentage. Interest is going to be 6 lakhs. Okay. So minus interest, that is equal to 6 lakhs. Very nice. So we'll get EBT is equal to 24 lakhs. Like you all said, we'll get 30 lakhs divided by 24 lakhs. That will be the financial leverage. 30 lakhs divided by 24 lakhs. Please do the calculation. 1.24 times. Yes. Now, the question is not what is financial leverage. Is it favorable? So, it is greater than 1. No. So, we will say it is a favorable leverage. Why? Now, if it is lesser than 1, what will happen? My commitment may be really high. Right? So, 1.25 times is greater than 1. So, favorable financial leverage. Yes, everyone? Okay. So now we will proceed and see how to go about the next. So the first 2 points are over. These are all unique questions, questions which are already solved in the class. You all know that really well. Yes. So does the firm belong to an industry whose asset turnover is 1? Does it have a high or low asset leverage? Okay. It all looks like it is all different. But again, they have discussed about ratios in other chapters, casually speaking. So they may ask this question together, wherein capital structure is also there. Okay. So now, what is asset turnover? And one more, having said this, working capital leverage is also there. Please add it to your checklist. If time permits, I will discuss that also. Working capital leverage, we have done, yes. Very simple it is. So please add that to your checklist. Okay. Asset turnover, any turnover ratio, turnover means what? Sales. Numerator is sales and denominator is that particular ratio itself. So that means sales divided by net assets is the ratio for asset turnover. Okay, turnover means what? Sales. Sales divided by net assets is the formula for asset turnover. Okay. Now, what is it? First of all, before answering to the question, first let us find out what is the asset turnover. What is the sales? 1 crore. Shall I write 100 lakhs? Yes. So sales numerator, I have substituted that to be 100 lakhs. Okay. Net assets. Already we did the net assets. Remember everyone? That is 60 lakhs plus 75 lakhs. Ma'am, how? Remember everyone. Net assets means what? In a balance sheet, we will have total assets and total liabilities, which will be same. Net assets means all the assets minus outside liabilities. Okay, all assets minus outside liabilities is what will be left for the owners. So outside liabilities means creditors, okay, bills payable, etc. Okay, so that means what is left out? Total assets minus outside liabilities means capital employed. No, yes, everyone. So again, I'm repeating. If you have forgotten this, many of you remember capital employed, that is share capital plus debt, everything, plus creditors is equal to total liabilities. And we know total liabilities is equal to total assets. So that means, can I say capital employed plus creditors, etc., is equal to total assets? Yes, ma'am. So capital employed is equal to total assets minus creditors. This is what is net assets, dears. Okay. So total assets minus creditors is nothing but net assets. That is equal to what? Capital employed. Okay. So now assets that is remaining after paying outside liabilities. That is only net assets. So now that is the denominator, which is 135 lakhs. 135 lakhs. 0.74 times. Okay. So it is lesser than the industry average. Everybody is getting, in my industry, everybody is getting one. I'm getting 0.74 means lesser than industry average. Like that, we should conclude. Okay. What are the operating, financial, and combined leverages of the firm? Okay. So now, did we already calculate financial leverage? Okay. So financial leverage is already done. Operating leverage we will do here. Operating leverage is equal to contribution divided by EBIT. Contribution is equal to how much? 40 lakhs divided by 30 lakhs. How much is that now? 1.33 times. Okay. Thank you, dears. Next up. What is the financial leverage? Financial leverage already we did. Simply I will write once here. EBIT divided by EBT. That is going to be what? Yes, 30 lakhs divided by 24 lakhs. How much did we get? 1.25 times. So combined leverage is equal to operating leverage into financial leverage, which is equal to what? 1.33 times into 1.25 times. 1.33 into 1.25, that is 1.66 times. So 1.66 times. So easily we have done this also, fourth problem also. So why I'm doing this problem, I will tell you. Generally, will they mix the questions from the various chapters and ask? They may. Okay, students ask me, ma'am, can they ask me a question which is combined from security analysis as well as cost of capital? They may. We have seen that happening in the past in the first question of FM. That is the compulsory question of FM Nalli. They will combine the chapters and they may ask. So that is why I'm doing this problem with you. There could be a case study where they're asking about these ratios also, where they're asking about capital structure also. So you need to be aware of it. So if the sales drops to 50 lakhs, what will be the new EBIT? Very simple. Let us do this. So sales is equal to how much? 50 lakhs. We are answering point number 5 minus variable cost given in the question. Now we all know that the variable cost was how much? 60 lakhs. Can I take 60 lakhs now? The variable cost, what is the definition? Definition is the cost that changes with the level or volume of output. Cost that changes with the level or volume of output. So for 1 crore, 60 lakhs, for 1 crore sales, 60 lakhs is the variable cost. That means, can I say variable cost ratio is equal to 60 percentage? Yes, I will apply this percentage. I hope everybody is very clear. This is why I'm choosing this problem. And the last problem is actually from where? From operational approach, that chapter. Oh, last point is from operational approach. Oh. So that means variable cost at 60% means 60% of 50 lakhs is 20 lakhs. 30 lakhs, right? 30 lakhs. Okay, no problem. So that means contribution is equal to 20 lakhs minus fixed cost. Fixed cost will not change irrespective of the level or volume of output. Fixed cost will be 10 lakhs only. So I will take the same fixed cost that is going to be 10 lakhs, which means EBIT is also going to be 10 lakhs. So the new EBIT is 10 lakhs. It is a wonderful question where multiple other chapters. So I will tell you. See, this is from capital structure. This is also from capital structure. These two are ratios, and this is operational approach chapter. Operational approach chapter, last point. So it is a mix of everything. It may be asked in the similar questions may come in the compulsory question. That is why we have done it. Okay. So capital structure, pretty much I've discussed everything. So for the things that we have not done problems, I want you to do the problems so that we can start with the other concepts also. So now, so now we will start with the other chapters. What are the other chapters? Working capital management, then security analysis, then operational approach. These are the other main chapters along with the dividend decisions also. All right. So in this conceptual coverage, I'm looking to do again past exam questions, which are a little bit different, which you may find it to be difficult when you're doing alone. Those sort of questions I have done. So let us now discuss. Okay, so I'll start with working capital management because that is considered to be a little bit huge. So let us discuss that. What are the basic sort of checklist that you need to make? Checklist is estimation of working capital. That is find out the working capital. So you will use to do all the current assets minus current liabilities and all that. No RM, WIP, FG. That in today's class also I will be doing it. So estimate working capital. Then we have this one, that is evaluation of credit policy. That also we will be doing. Which credit policy is better? 3 months or 2 months or 1 month? Which is better? We are giving for debtors, no credit period. 3 months or 1 month or 2 months, which is better? We have to do analysis, right? So that one. Then, as I told you in June exams, they're always testing on reorder, minimum, maximum, average levels. That also you need to give importance. EvoQ Baumol model of cash. Baumol model of cash. Okay. Approach of cash. All this we have discussed. So these are the main checklists that comes to my mind when I say working capital management. And apart from that, factoring, forfeiting may be a little important in terms of theory. So these are the questions that you have to definitely go through. This being repeated in June exams. But the evaluation of credit policy is quite some time since they have asked this. So we may expect that also. Okay. So that is also quite an important. So now tried and included as much as possible in the marathon. So now, JKL Limited is considering the revision of its credit policy with a view to increasing its sales and profit. Currently, all its sales are on credit and customers are given 1 month time to settle its dues. That means current time that is given is 1 month. Okay. It has a contribution of 40% on sales. Okay. And it can raise additional funds at 20% per annum. Okay. The marketing manager of the company has given the following options: sales, credit period, bandits, cost of credit administration. This is not anything new, but it was a little bit different. So I just pulled this question. You're required to advise the company for the best option. A little bit different in the sense from what is given in the general questions. Okay. So now let us see how to do such evaluation of credit policy. Yes, you all know the format, so we will write it down. So anyone who wants the format, you people can also write it down. So sales minus variable cost minus fixed cost. If fixed cost is not given, you can stop with the contribution right now. So minus bad debt minus opportunity cost minus cost of credit administration, you will get profit. Based on whichever profit is higher, you will choose that option. Opportunity cost, yes, dears, we are having a working note. Good enough. You people will remember it, I'm sure about that. Opportunity cost, what is the working note? It is going to be debtors into collection period into percentage. We will discuss this. Okay. This is the format. So those of you who want, you can write down the format for what? Evaluation of credit policy. 1 month is better, 2 months is better, 30 days is better, or 60 days is better. For such questions, we will actually follow this one. So we will now go ahead in the same format. Okay, sure. So if you note down this format and keep the day before the exam, you can actually go through this and get away with the revision very quickly. We had three options and also we had the current period. Am I correct? Yes. So particulars, correct 1, 2, and 3. So some students, not all of them, I am correcting the test papers, I just saw that some students are missing the current that you know particular column. Well, that is also there because we have sometimes the current option may be the best option. So we have to reject all other proposals. So that is also something that you have to take into consideration the current column. So the sales is going to be what? I'll take it from the question. It's there in the PDF. So all of you please refer to it. I'm just taking all the figures from here. Good. All of you are comfortable. So now, for those of you watching online, it is given in the description box. Please check it out. So 200 lakhs All amounts are rupees and lakhs. You can mention that. So 210, 220, and 250. Okay. So minus variable cost. Variable cost is going to be what? Okay, they have given directly contribution. You all can see it is going to be contribution at the rate of 40% is given. So directly we can calculate contribution at the rate of 40%. Now, some people try to work on incremental benefit or incremental cost. See, that is your choice. Okay. So this is more easier for my students. So I'd like to do it this way. Okay. This is 80. Yes, ma'am. 84 and 88. And then this is 100. Okay. So now, so we have sales minus variable cost we used to do. Contribution is directly given. We have taken that. Fixed cost, no information is given. So directly we will go to the next one, that is bad debt. You can do it in any order. So first you can do cost of administration, then you can do bad debts, opportunity cost. That is okay. So bad debts, they have given in the question, it is to be percentage of sales, right? So it is going to be 2 at the rate of 2, 2.5%. Then it is given third line of the table. Yes, dears. 3% and 5%. So just apply it on the sales. So these percentages will be on sales. Okay. So it is going to be 200 into 2%. That is, yes, 4. Okay. So then 5.25. Okay. Next is 3% on sales, 6.6 and 12.5. Okay, dears. So bad debt is done. Now we will do minus cost of administration. Again, it is given in the question, dears. So I will just take it. It is 1.2, 1.3, 1.5, and 3. Given in the last row of the table in the question. So, and we are following the format. Just now we recalled that also. And we are going to do what next? Opportunity cost. So that wherever profit is higher, I will choose that credit period for my debtors. That is the logic. Okay, ma'am. Because you all can see bad debt will increase when we give more credit period, the bad debt is increasing. Okay. So same way, cost of administration also. We need to call them and remind them, no, please pay your dues, please pay your dues. We need to send mails, reminder mails. For that, we need a person and we need to give that person a salary. So you can imagine that way. That is also increasing when you're having longer credit period. Opportunity cost. For this, we will do working note as I told you. So the working note is going to be, you all know it is going to be debtors into collection period into percentage. I'll explain why. Now, for the current scenario, what is the debtor, students? The debtors is going to be given to be 200. That is a sales. Okay, I'm assuming sales as debtor. So 200 into collection period is how much? Can you all see the second row of the question? It is given 1 month. Very good. So into 1 divided by 12 months. Okay, why, ma'am, you're doing this? Now, I am like waiting for 200. Am I waiting for the entire year? No. 1 month I'm waiting. That means 200 divided by 12. So 16.67. Okay. To that extent, I'm waiting for 1 year. All right. So I'm waiting for 16.7 lakhs. Okay. And had I invested this anywhere else, instead of giving this money in the business and giving it to the debtors and waiting them for 1 month, had I put it anywhere else? See, for example, in the stock market, I would have got, stock market is just an example, okay? I would have got what 20 percentage. Okay, like that, I want you to imagine. So, like that, I want you to imagine. So, it is going to be into 20%. So, had I invested in this instead of 200 lakhs, investing for 1 month, okay, I would have invested in the share market for 20%. Ma'am, why should you do 1 divided by 12? Because 20% is the Percentage for one full year. 20 percentage is the percentage for 12 months. That means for 1 month, how much it is. That is why we are doing into 1 divided by 12. Okay. This is the logic. Instead of putting in the business, had I put anywhere else, I would have got 20 percentage is the logic. Okay. So the next sales is going to be, so like that, we will just calculate 200 into 2 or 200 divided by 12, yes, ma, into 20 percentage. We are getting 3.33. Okay. The same way, let us do the calculation for the rest also. So it is going to be 210 into, for the second option, how many months? 1.5 months. 1.5 months divided by 12 months into 20 percentage. So let's do the calculation. 210 into 1.5 divided by 12 into 20%, right, dears? So 5.25. Okay. So next up, we have 220 into 2 months divided by 12 months into 20 percentage. 7.33. 250 into 3 months divided by 12 months into 20 percentage. 12.5. So this is how we are supposed to do it. Those of you, please, yes, please quickly make note of it. I'll wait. Quickly make note of it. So now let's go and substitute 3.33, 5.25. 3.33, 5.25. Yes, ma. 7.33 and 12.5. 7.33 and 12.5. So this is the opportunity cost that I was talking to you when I was explaining the format. So I think now it makes more sense. Instead of investing and giving the money to my debtors, had I invested in, say, for example, a stock market, what I would have got 20 percentage. So based on that. Okay. So then we will calculate the profit. चलो 80 minus 4 minus 1.2 minus 3.33. We will get 71.47. 84 minus 5.25 minus 1.3 minus 5.25. Just a minute. Yes, we'll get 72.2. Okay. So then here we will have 88 minus 6.6 minus 1.5 minus 7.33. We will get 72.57. Okay. Then now, here we'll have 100 minus 12.5 minus 3 minus 12.5. We'll get 72. Okay. So which one is better? All of you. Very simple. Highest profit is better. So we'll prefer the second option, this column. We will prefer. Okay. What is the number of months for the second option? 2 months. So conclusion is 2 months credit period is better option due to higher profits. Due to higher profits. So this is done. Now, this problem, instead of just doing EOQ, I thought I will do EOQ along with the discount. We have done a quantity discount problem along with EOQ in the regular classes. Some of you initially you found it to be difficult. Then after we explained and we did it together, you all found it to be easy where there was discount. Yes. So now a similar problem I have chosen so that we'll, revise that concept as well. So EOQ as well, reorder level, minimum level, maximum level, everything. So we will discuss all this. Okay. So Now we will proceed to. Anyone wants to write this? Please write up. Please write up. Please be a little quick and then we will proceed. Okay, done. So now we will proceed to this. So we have now this question is there in CA material also. CMA material also. It is a past exam CS question also many years ago. So they may ask you one. I have already told you June exam is asking minimum level, maximum level, etc. So they may frame a question which is like we don't. So now Messrs. Tubes Limited, has given the following information. Average monthly demand is there. Ordering cost, inventory carrying cost, cost of tubes, normal usage, minimum usage, maximum usage, lead time, everything is given. From the above, compute the economic order quantity if the supplier is willing to supply quarterly 1,500 units at a discount of 5%. Is it worth accepting? Okay. So first, we should, find out the EOQ. Then, is this offer worth also? We should understand. Okay. The mark weightage can be around 8 to 10 marks. Yes. So, yes. So, if they are asking a 5-mark problem, accordingly, they'll reduce the size. Maybe they will not ask maximum level, minimum level, etc. If they are asking in the first question, they may ask the full thing. Okay. So, now let us proceed to EOQ calculation. EOQ is equal to what? Economic ordering quantity is the full form. So square root of 2AB divided by C, where A is equal to the annual requirement. Annual requirement. B is equal to ordering cost per order. C is equal to carrying cost per unit per order. Okay. So now let us find out what is A. Monthly demand is 2000. Right, students? Okay. Now, many students are taking monthly demand. Right. Now, they have given here monthly demand. Okay. What is the normal usage? They have given 100 tubes. Okay. Now, here is where many students go wrong. I told you it is a question which is there in CA material. I mean, CA, I don't know if it is there in MTP or anything. CMA material, it is there. Yeah, CA material also it's there. CMA material also it is there. And CS past exam question it is. Okay, same numbers also. Okay, so annual requirement. It is a requirement. It is not demand. So my demand may be 2000 tubes. But how much I am requiring? Normally, I am requiring how much? 100 tubes per week. But I want annual requirement. This is my weekly requirement. How to convert weekly requirement to annual requirement? For 1 week, it is 100 tubes. How many weeks are there in a year? We all know 52 weeks are there in a year. Okay, which means should I not do 100 into 52? Yes. So some students by mistake, they are taking the monthly demand. It has got nothing to do with our annual requirement of raw materials. That is the normal usage. Okay. How much I'm using in my production. That is what is RM requirement. Okay. So now we will proceed to ordering cost per order. It is given in the question that second line of the question, it is rupees 100. Carrying cost per unit per, see, 1 minute. Actually, what I meant was carrying cost per unit per annum. Yes. Now they have said it is going to be 20% as per the third row. Many people are taking only 20%. That is why I'm saying carrying cost per unit per annum. What is per unit cost given in the fourth row of the question? Okay, fourth row of the table, that is going to be into 500. So how much is that? 100? Okay. So I hope everybody has written this. So A, B, and C, we have written everything. Now we just need to substitute. That is going to be EOQ is equal to square root of 2AB divided by C. Now we will substitute that. That is going to be 2 into A was 5200, B is 100, divided by C is also 100. So come on, do it, everyone. 101.98, right? So because the number of kgs or raw materials cannot be tubes, no, given tubes, I cannot take it as decimals, so I'm taking it as 102 tubes. That is the EOQ. Okay, that is the EOQ. Okay, we have done this. Now we will proceed to the next. So we know this. Now in this they have asked if the supplier is willing to give 1500s for a quarter of with a discount of 5%, is it worth accepting? Whenever you have such a situation where you need to accept the discount or EOQ, you need to calculate the total cost. Total cost is what? Very nice. Purchase price plus ordering cost plus carrying cost. Right, good job. One, just erase it and then I will write it for. Whenever you need to compare between EOQ and discount, you need to calculate the total cost. Total cost comprises of what? First of all, I need to pay purchase price. Suppose you are ordering in Amazon, you need to purchase the say for example we are buying shirts. For the shirt price, you will that will be 500 rupees. So that will be there. Then we will have what? Ordering cost. Ordering cost means what? Shipping cost. Okay. For every one order in Amazon, say for example, the shipping cost is 50 rupees. Okay. That is the shipping cost, ordering cost per order. Carrying cost. What is the carrying cost? Carrying cost is nothing but you are, you have to carry it in your wardrobe, right? What is the cost of maintenance of the shirt? You need to do laundry, ironing, etc. So what is the need to buy a new wardrobe and keep it, right? So this is the carrying cost. Okay. So now carrying cost, how you will calculate is carrying cost per unit per annum into half of inventory. Why half of inventory? Because one half only will be kept in the wardrobe. One half will be used, on an average. I'm saying, say for example, forget about the shirts. RM, raw material is purchased. Okay. I'm purchasing wood to make tables. Will all the wood be lying in the stores? No, half will be gone for production. No, on an average, half will be gone for production. That is why this is going to be nothing but what to say, carrying cost per unit per annum into half of the inventory. Okay, so like that we should do. Now let us proceed. So the heading is evaluation of discounts, particulars, current, proposed discount. Okay. Purchase price. So I'm referring to everything that is given in the question. So the purchase price, you all can see that the cost of the tubes given in the fourth row of the question is going to be 500 per tube. All right. So can I say 5200 into rupees 500? Yes. And here the proposal is going to be what? 5200 into rupees 500 into 95%. Why, ma'am, into 95 percentage? 5% is the discount that we will get. Ma'am, quarterly, no problem. We are estimating the cost per annum. We are estimating the cost per annum. Okay. So it means 5200 into 500, that is 26 lakhs. Okay. Is already calculated. Okay. 24 lakh 70,000. 24 lakh 70,000. So purchase price is done. Now we will do ordering cost. Now let us see how many orders we should place. Okay. So, what is the meaning of EOQ, students? Yes, a full form is economic ordering quantity. But what is the meaning of this? Every time I'm ordering, I will order 102 tubes. I'm again saying every time I will order 102 tubes. So that is the ROQ. In other words, if nothing else is given in the question, ROQ is equal to EOQ. Like that, we can assume. Okay. So now we will proceed to totally we need how much? 5,200. Every time I'm ordering, how much I'm ordering? 102. Right. So into ordering cost per order is 100. So this will be the cost here. And here, what will be the cost? It will be nothing but I'll do it here itself. It is going to be 5,200. And how many times I'm ordering? 4 times. Right. So can you all see per quarter? I will show it to you. They have given in the question 1,500 for every quarter. Okay. So 1,500. So every time I'm ordering how much? 1,500 into rupees 100. Please do this and tell me how much it comes out to. 5098. Okay. And now just one. 347. So you can see the ordering cost has drastically come down. Suppose you want 10 shirts, you're ordering all the 10 shirts in one order itself, then your shipping cost may be only 100 rupees. Every month you're ordering one shirt like that for 10 months you're ordering. That means every month you have to spend on the shipping cost of 50 rupees. No? So that is what I want you to imagine. Okay. All this most of you know, but I'm just giving you a recall of what it is. Next is going to be carrying cost. We all know it is one half of ROQ, okay, into carrying cost per unit per annum. Okay. So it is going to be 102. Every time I'm ordering, how much I should keep in my stores? 102 tubes. Half. I told you, no, half of inventory. Okay. Into carrying cost is going to be already we did it was 100, correct? How did we get 150 into 20? 500 into 20 percentage. Remember? Yes, already we have done. Okay. Now, this is going to be what now? Here it is 1,500. Every time I'm ordering 1,500 divided by 2 into 500 into 95 percentage into 20 percentage because I'm getting 5% discount in my proposal. All of you please do and tell me how much are we getting, students? 5,100. Okay. And then 71,250 is it? Okay. I'll also do the calculation. 71 to 50. So, and how will you cross verify for such problems? Generally speaking, ordering cost and carrying cost will be the same in EOQ. 5098 is same as 5,100. No, this is 5,100. So they will be same in EOQ. Okay. So now we will calculate the total cost and then we will decide which is better. 26 lakh 10,198. Okay. And what about this? 25 lakh 41,597. Okay. So which means which is better? This is better. Accepting the proposal is better. It is giving me lesser cost. We are not talking about profit. Cost is lesser than current situation of EOQ. Cost is lesser than EOQ. Okay. So I hope everybody has understood. Now, maximum level, minimum level, and reorder level. This also we will. Okay. So now, yes, we have one more working capital estimate question also. Yes. We'll get back to this. Maximum level is equal to what? ROL plus ROQ minus minimum usage into minimum lead time. Okay. So maximum level is equal to ROL plus ROQ minus minimum usage into minimum lead time. We all know this. So what is the ROL? Okay. So what is the reorder level? Now that is not given in the question. So let me just find that out. Okay. So I will do it here. Reorder level is equal to maximum usage into maximum lead time. Maximum usage into maximum lead time. Very simple. All this we have done in the regular class. Good. Most of you remember it also. Maximum usage is equal to 200 tubes given in the question into maximum lead time. So lead time can be anywhere between 6 to 8. Maximum will be 8. So 200 into 8, that is going to be 1600. So this is the reorder level, 1600 tubes. So when I will order again, when I'm having 1600 tubes in my warehouse, I will place the next order. That is the reorder level. How much I'm ordering? That is reorder quantity. Okay. Now, minimum level. So why did I do reorder level first? Because I needed this, right? That is why. So first I'll finish maximum level. Maximum level is what? Maximum level is reorder level. That is 1600 plus ROQ. Ma'am, ROQ, ಯಾವುದು ತಗೋಬೇಕು? We will take EOQ in the absence of any information. In the absence of any information, we'll take EOQ. If you think you are at risk, please give a footnote. No information is given about whether we should take EOQ or 1500 for ROQ. So I'm taking EOQ. But normally you can take EOQ for ROQ. How much is the EOQ students? 102. Right. Minus minimum usage. What is the minimum usage? 50. And what is the minimum lead time? 6. So 50 into 6. Please do the calculation and let me know how much is the maximum level. Come on, students. One four zero two tubes. Okay. This is the maximum level. Again, I'm saying maximum level is ROL plus ROQ minus minimum usage into minimum lead time. So we are getting 1402. For that purpose only, first I did ROL, reorder level, because it's not given in the question. So we found out ROL. How did we find out maximum usage into maximum lead time? So using that only, I did maximum level. Now let us do minimum level. I will do it below. Minimum level is equal to ROL minus average usage into average lead time. Average usage and normal usage are all one and the same only. ROL is how much? 1600. Just now we calculated. Minus average usage is the same as normal usage. How much is normal usage? 100. We took for EOQ calculation. Yes. How much is the average lead time? Minimum is 6, maximum is 8. So 6 plus 8 divided by 2 is the average. 6 plus 8 divided by 2, 7. So it is going to be 100 into 7. Just calculate and tell how much are we getting here. 900 tubes. All right. That is the minimum level. So we have done this also. So we have covered good amount of concepts here. EOQ also, discount also we have considered. We have already finished what? Credit evaluation policy. Now we will do working capital estimation and then we can take a break. Wherein after that we will continue with the rest of the things. have not chosen a very complex question for working capital. I have not chosen a complex one because most of you have understood everything in the regular class. So it is only for practice and recalling purposes. So you can nevertheless, practice at home. And once in December, in the recent exams, uh, 24 or 23, the working capital was asked for 12 marks, 20 marks. Okay. So working capital estimation, projection of P&L balance sheet, which we have done in the regular class from the ICSI material. That was similar question was asked. Projection of P&L balance sheet also 20 marks total. It was asked in December exam. Just you can practice. I will do one practice and I'll do one practice question now. So XYZ company has a production cycle and it is introducing wages and overheads which are occurring evenly throughout the cycle. Wages paid in the next month, following month of accrual, time lag is 1 month. Okay. Now the work in progress. So what we need to understand is wages get the time lag is 1 month. Work in progress includes full of raw material and 50% of wages and overheads. That means what now? Work in progress means wood is getting converted into tables. Let us take the same example. Wooden logs is the raw material. It is getting converted into tables. Will it get over in 1 day? No, it will take some time. That is called as work in progress. Okay, it started, but it is not yet completed as a table. So for that, what and all we need? We need wooden logs, which is the raw material. We need labor who is actually cutting, welding, and all that. So we need labor also. We need overheads. We need electricity. We need to pay rent, supervisor salary, all this. So labor and overheads, will it be fully paid? No. Raw material fully I need for starting my table. Full raw material I need. But labor and overheads, see, they will be working on other tables, chairs. They will be working on cabinets, other interiors also. So that is why we will take only 50% on an average. Even if it is not given in a question, we need to write the assumption and then we should take 50% for wages and overheads as far as work in progress is concerned. Okay. So now next is going to be, they have given production of pipes, duration of pipes production cycle. Okay. Raw material held is 1 month. Okay. Finished goods held is 2 months. Credit allowed by creditors is 1 month. Given to debtors is 2 months. Cost of raw materials, direct wages, overhead, selling price, everything is given to us. Calculate the amount of working capital required for the company. So it is working capital estimation. Let us see how to do. So we will start with, so as I told you in the exam, you can have 3 columns. One is particulars, computation column and amount column. Computationally, you can show all the computations. So to go a little bit fast, we will do everything together. Okay. So now we'll start with what is the format for working capital? So remember like this, students, RM will get converted into WIP. WIP will get converted into FG. FG will get converted into debtors once it is sold. Then what we will get? We will get cash. But will I get that cash fully? No. I need to pay the creditors from whom I purchased the raw materials. So I will pay them the cash. That is why all current assets, raw material is a current asset. Stock, no? WIP is also current asset. FG is also current asset. Stocks are my current assets. Debtors is also my current asset. So minus creditors, current liabilities, whatever cash I'm getting, that is only my working capital. Isn't it, students? Now I hope it makes more sense. Current assets minus current liabilities. That is the balance cash that we have. The regular students know all this. So we have to start from RM, WAP, FG, debtors. Then we will subtract creditors and we'll be done with the working capital estimation. You all know that while we are estimating the working capital, we generally take the cost of debtors. Okay. So now we will proceed. Raw material, that is going to be 12 lakhs. The question is in the PDF, so directly I will do it. So it is going to be 12 lakhs units into What is the cost of raw materials, my dears? Rupees 60 into what is the wait time for raw material? It is given in the third line of the table, third row of the table, 1 month consumption. So 1 divided by 12. So in 1 year, what is my raw material cost? That I'm finding out. So 12 lakhs into 60 lakhs. Okay, ma. Thank you. So 60 lakhs. Okay. Then we will do WIP. WIP ಗೆ RM ಪೂರ್ತಿ ಬೇಕು. So we will take 100% of RM. For wages or for labor and overheads, we will take only 50 percentage. Okay. So we will take material, labor and overheads separately. Okay. So material is going to be how much? We all know that it is going to be 60 rupees. And overheads is how much, ma? Sorry, labor and overheads is going to be, can you all see, given in the last three lines, that is 10 and 20. Okay, of the table towards the end, they have given this into 50 percentage. So it is going to be rupees 60 and 30 into 50, yes, ma, is 15. So totally 75 is the cost of WIP. I hope everybody is able to understand. 50% for labor and overheads. Full raw material will take, labor and overheads over a period of time only we will pay. So it is going to be what? Rupees 75 into how many units? 12 lakh units into WIP. The production cycle is given to be 1 month. Second row of the table. So 1 divided by 12. How much is that? Let us understand. So it is going to be 75 lakhs, is it? All right. Thank you. So 75 lakhs, that is done. Now we will do FG. FG, see, finished goods means full labor overheads, everything should have been incurred. Yes. So this 50% business was only for WIP. Work is still in progress only. Wages and overheads will be delayed. If it is over, wages and overheads has to be paid. It will be incurred. So it is going to be raw material for making finished goods. What and all I need? Raw material I need. Then I need what? Labor and overheads. How much is that, dears? It is 60 plus 10 plus 20. That is going to be what? 90. This is the cost for how many units? 12 lakh units. And finished goods inventory held for 2 months is given in the fourth row of the table in the question. So it is going to be 12 lakh units into rupees 90 into 2 divided by 12. Okay. How much is it, students? Yes, 1 crore 80 lakhs. Thank you, dears. So now we will proceed to debtors. Debtors, FG only can be sold, no? Correct. So that means RM plus labor plus overheads ಪೂರ್ತಿ incur ಆಗಿರ್ಬೇಕು. So which means we'll take 10, 60 plus 10 plus 20, that is 90. As per the conventions of accounting, while you're estimating your cost, we will take only the cost. Conservatism concept, no? Anticipate no possible gains, but anticipate all possible losses. So we are estimating the debtors at cost is a conventional practice. So we are doing it. Of course, conservatism is for accounting, but still we are using it for estimation purposes also here. Okay. So 12 lakhs. But suppose if you have taken the debtors at selling price, because selling price is given to me, ma'am, I am taking it at that, you have to give a note saying, I have taken the debtors at selling price for working capital estimation. Alternatively, it can be calculated at cost also. Like that, you can give a note to be on the safe side. Okay. So rupees 90 into what is the debtors period? Can you all see? Credit given to debtors is given to be 2 months. Okay, in the table, 2 divided by 12. So I think it is the same calculation. Yes, ma. So it will be 1 crore 80 lakhs again. 1 crore 80 lakhs again. Now what we will do? we will subtract the creditors. So I already told you, students, raw material, WIP, FG, data minus creditors will give me the, yes, working capital. So the same is for cash cycle, working capital cycle. Very good. So now we will, the working capital cycle, cash cycle also you can include in your checklist. Very simple. Just go through that. Okay. So creditors, the time period given is obviously what 1 month, given just above the debtors in the question. Okay. So the credit allowed by creditors is given to be 1 month. Okay. Now only raw material will be creditors, no? Yes, ma. Only raw materials we will buy from our suppliers. So that is going to be 16. Okay. So now 12 lakh units into rupees 60 into 6 into 1 divided by 12. Yes, dears. So how much is that? 60 lakhs. Okay. Next, usually we will stop with this, but in this question, I already told you in your regular class also, that is only if they say wages or overheads is outstanding, we will take it. Otherwise, normally it should have been paid. Here they are saying it is 1 month lagging, so we will take the wages. Okay. So it is going to be wages outstanding. Wages is going to be what? Rupees 10 given in the question. So it is going to be 12 lakhs into rupees 10 into 1 divided by 12 because the lag is 1 month. Please do the calculation and help me out. 10 lakhs. Okay. So, so now I've just reduced it so we will be able to see it. So and see the entire problem together. So we will add RM, WIP, FG, data. We will subtract the creditors and the wages. Then we will be able to get our working capital. One of the very good problems. So all of you calculate the working capital and tell me how much are we getting all current assets minus all current liabilities. 4 crore 25 lakhs. Done. So working capital also done. So now let's begin with the dividend policies. Okay. So now I've included one from approach, one from Gordon, and one from Walter. These are the three important, right, discussions that we used to have in dividend decisions. So let us do that. All are past exam questions. Some are, I think this is last long back, but it's still relevant, right? So X Limited has 8 lakh 8 lakh equity shares outstanding at the beginning of the year. And the current market price per share is rupees 120. That means, can I say P0 is equal to 120? Very nice. Okay. So P0 means price of the share right now. The board of the directors is contemplating 6.4 per share as dividend. Okay. The rate of capitalization appropriate to the risk class to the company which it belongs to is 9%. Based on approach, calculate the price of the share when the dividend is declared and not declared. How many new shares are to be issued if the company desires to fund an investment budget of 3.2 crores by the end of the year, assuming net income for the year will be 1.6 crores? Okay. So now let us see how we need to go about this. I'll prove and show you as to how we can, conclude that our answer is correct in approach. Right. So now we will proceed to, in approach, what is the formula? P0 is equal to D1 plus P1 divided by 1 plus KE. All right, students. Now, The question is, ma'am, P0, we understood that right now the price is 120, but what about 6.4? Is it dividend already paid or dividend to be paid? They are saying the company is contemplating, that means it is to be paid. D1 is 6.4. Okay. So which means P0 is 120. I'm substituting it. D1 is 6.4 plus P1 divided by 1 plus KE. We all know that KE is given in the question, that is 9 percentage, right? 9.6, sorry, 9.6 percentage. Okay. So now divided by 1 plus 0.096. Okay. So now that means 120 into cross multiplication. We all know that 1.096 is equal to 6.4 plus P1. Okay. So which means, yes, dears. Are we getting 11.52? Okay. 120 into 1.096. 131.52. 131.52 minus 6.4. That is 125.12 is P1. P1 is 125.12. This is when dividend is paid. When dividend is paid. So again, I'm saying when dividend is paid, we will take 6.4 in the place of D1. Otherwise, we'll take it as 0 when dividend is not paid. Okay. So when dividend is not paid, that is what is the first question, right? We need to estimate the share price, right? P0 is equal to D1 plus P1 divided by 1 plus KE. All right, students. What is P0? It is given in the question that P0 is 120 is equal to D1 will be 0 because dividend is not paid. Okay, we should find out the prices under both the options is what the question has told. Plus P1, that is what we need to find out, divided by 1 plus 0.096. Okay, so that means 120 into 1.096 is equal to P1, 131.52. Right here, thank you. 131.52, that is the P1. Okay. So we have calculated the share prices when dividend is paid and when dividend is not paid. This is over. Both are over, A and B. Now, how many shares are to be issued if the company decides to fund an investment of 3.2 crores? Okay. So now, very simple. Many people are complicating it by learning the formulas. So, yes, my students, I know that you people will not be doing it. So you can logically think and do it. Yes. So now we will see how to go about it. Calculation of number of shares to be issued. So they have just said how many new number of shares to be issued in the question. You all can see that. They have never said if the company has to pay the dividend or not. So we will do both. Yes. Yes. In the exam also, if it is not given, please do both. Okay. So now we will proceed to first one. That is going to be how much is the net profits that we are having. You all can see in the question. I'll show it. The net income is going to be 1.6 crores. So that means right now I'm having a profit of how much? 1.6 crores. So 1 crore 60 lakhs. 1 crore 60 lakhs. Okay. Now what are we supposed to do? Minus from the profits only we will pay dividend, right? So minus dividend. Dividend is given in the question 6.4 per share. How many shares are there? 8 lakh shares are there. So shall I say 8 lakh shares into rupees 6.4. How much is that, students? Okay. So are we getting 51 lakh 20,000? Yes. So of course it is only for the first column. Second column, dividend is not paid means nothing will come. So the profits available after distribution of dividend or the retained earnings is how much? 1 crore 8 lakh 80,000, and here it is 1 crore 60 lakhs. This much is the profits that is available. Okay. Now what we are supposed to do next? So totally profits I have. Out of that, I paid dividend. Balance profits, how much I'm having. This we have found out. Okay. Now, what is the total investment? Total investment that is to be made is 3 crore 20 lakhs. Whether I'm paying dividend or not, what? 3 crore 20 lakhs. Here also it is 3 crore 20 lakhs. It is given in the question. So now, how many funds extra I need? Funds extra I need means I need how much? I will write it in red color. I need this much. Okay. I already have how much? This much. That means how much is balance required? 3 crore 20 lakhs is what I need. But I already have 10880000. That is, I already, out of 3 crore 20 lakhs, I already have 1 crore 8 lakh 80,000. So how much is balance I need? 2 crore 11 lakh 20,000. Okay. Now, this is, you all know, very simple. 3 crore 20 lakhs I need. 1 crore 60 lakhs I'm having means 1 crore 60 lakhs is what I need now extra. All right, students. So now I need this much extra. Whom I will ask? I will ask my shareholders. Okay. So number of shares. Now I will write first a price. Price of shares. Already we calculated, my dears. We will take that. How much is it? 125.12. And the other one was how much, ma? 131.52. Okay. So 125.12 and 131.52. Okay. So every one share will give me 125.12 or 131.52 as the case may be. But I need how much? 2 crore 11 lakh 20,000. So I'm saying again, one share gives me how much? 125.12. That means how many shares will give me 2 crore 11 lakh 20,000 is the question. Okay. So how many shares we need to raise? Very nice. So cross multiplication 2 crore 11 lakh 20,000 divided by 125.12. So 2 crore 11 lakh 20,000 divided by 125.12 is 1 lakh 68,797. 798 we will keep rounded off. Okay. So that is the number of shares. This is the number of shares. Same way, 1 crore 60 lakhs divided by 131.52. How much is the number of shares? 1 lakh 21,655. That is the number of shares. Okay. So up to this only it is asked in the question. Now I will write in red color what is not asked, why we are doing, just to verify if our answer is correct or not. Okay. Now, whatever I'm writing in red color is simply for our understanding. Okay, that only this much is asked in the question. Okay, number of shares to be raised. Okay, so we are doing these things to check our answer. Okay, what is it? Number of existing shares. Number of new shares we found out. Number of existing shares already given in the question, 8 lakh shares. Given in the first line of the question. Yes. I'll show. 8 lakhs equity shares. Correct? Okay. So now that means what is the total number of shares? Nine lakh 68,798. And this is 9,21,655. Okay. So now the price of the shares. Price of the shares already we calculated 125 and 131, 125.12 and 131.52. Now with this, let us find out the market value of shares. So that is going to be 9 into 10, number of shares into market price. So all of us, let us do it. 9 lakh 68,798 into 125.12. We are getting what? 5? Yeah. 12 crore, 12 lakhs, 16,005. 9 lakh 21,655 into 131.52. That is also 12 crore, 12 lakh 16,600 we are getting. No, 65 we are getting. That 60 rupees difference is due to rounding off. But you can see the market value is the same, whether dividend is paid or dividend is not paid. The whatever I've done in red color is for cross verification. So our answer is matching in both cases. So the number of shares is correct. Okay. So this is the approach. Sometimes they ask us to prove also in the questions. In the ICSI material, it is there. We have done. So those of you have not done, please do after the conceptual explanation is done. Okay. So this is done. Now we will proceed to Gordon's model. Now, what is Gordon's model? Let us understand. Gordon's model is saying P0 is equal to E into 1 minus B divided by KE minus BR, where B is equal to what? R is equal to what? Everyone. B is equal to retention and R is equal to IRR, internal rate of return. So in depth, we have discussed the Gordon's model in regular class. Because it's a marathon, I'm just confining myself to the formula. Okay. All right. So this is the Gordon's format. So 1 minus B, 1 minus retention is nothing but payout. Yes. E stands for EPS. E stands for EPS. B stands for retention. KE is cost of equity. Again, B is retention. R is internal rate of return. BR is equal to G. We all know that BR is equal to G. So everybody has written it down. Now we will proceed. Profit before tax is given, tax rate is given, retention ratio is given, number of equity shares is given, equity capitalization rate is given, rate of return on investment is also given. So this is R and this is KE. Now find out the price of the share using Gordon's dividend policy. Very simple. T0 is equal to E into 1 minus B divided by KE minus BR. Okay. KE is equal to this, R is equal to this, B is equal to this. So we know B, we know R, we know KE. E alone we don't know. How to do that? Let us understand. E means what? E stands for EPS. EPS is equal to what? Earnings available for equity shareholders divided by number of equity shares. Okay. Earnings available for equity shareholders divided by number of equity shares. Earnings available for equity shareholders, how we need to calculate? PBT minus tax, we will get PAT minus preference dividend. We have no time for doing all that. So, okay, nothing more. I'm just saying PBT minus tax, we will get PAT minus preference dividend, we will get earnings available for equity shareholders. Preference dividend is not given in the question. PBT is given to be 2.5 crores and the tax rate is what? 40%. That means balance is going to be what? PAT. So 2.5 crores into 60%, that is 1.5 crores is the earnings available for equity shareholders because there is no preference dividend. So 1.5 crores divided by number of equity shares is given to be 50 lakhs. So divided by 50 lakhs. So we are getting 3. Right, students? Rupees 3 per share. That is the EPS. So we found out the EPS. Now we will be doing the price of the share. I think it's quite simple. So E is equal to 3 into 1 minus B is 40%. So I will write 0.4 divided by KE. How much is KE? 12%. I'll write 0.12 minus B. Again, 0.4 into R. R is how much? 15 percentage. So into 0.15. Like that we will do. So first I will do the denominator. 0.15 into 0.4 we'll get 0.06. So 0.12 minus 0.06 we will get 0.06 and 3 into 0.6 we'll get 1.8. So 1.8 divided by 0.06 is rupees 30 is the price of the share. Rupees 30 is the price of the share. Gordon's model. Quick revision. If they have said Gordon, we have to use Gordon only. Please don't use any other, um, you know, model. You will not be awarded marks. So in dividend chapter, what are the checklists that you have to do? approach, Walter model. Then we have Gordon's model. And then what I wanted to tell in between is the revised Gordon model that also we have done in the class. Intrinsic value of the share. Intrinsic value of the share. There is one problem in the material. Please do that. If anyone has any questions, please do ask. Online students can always, ask your questions in the comments. Definitely, I will look into it and I'll try to work on the questions that you want me to work on. Okay. Next is Walter model. They have given earnings, dividend payout, number of shares outstanding, KE and R. Okay. So what is the market value and what is the optimum dividend payout ratio? This is what they have asked. Okay. So what is the optimum dividend payout ratio for this? We should answer separately. Okay, ma'am. So what is the price of the share? T0 is equal to D plus R divided by KE into E minus D, the whole divided by KE. I hope everybody is able to remember it. I told you this numerator looks like CAPM formula also. I told you already. RF plus beta times RM minus RF, KE divided by KE, everything I told you. Oh, now what is D? E is given in the question? No, we need to find out E. E means earnings per share. EPS is equal to earnings available for equity shareholders divided by number of equity shares. Here they have directly given earnings of the company. So which is equal to what? 5 lakhs divided by 1 lakh, which is equal to rupees 5 per share. This is the EPS. Okay. In that, the dividend payout ratio is 60%. So that means, can I say dividend is equal to rupees 5 into 60 percentage? That is equal to rupees 3. So dividend also we have taken. So dividend is equal to rupees 3 plus R. R is how much? 15 divided by KE is 12 percentage. So 0.15 divided by 0.12 into E minus D. What is E, students? E is 5. So 5 minus 3, the whole divided by KE. KE is how much? 12 percentage, 0.12. So now first let us do the numerator, and then numerator separately we'll calculate, then we'll do the whole fraction. Come on. 1.1, divided by 0.12 into 2. 2.5. So we will get 5.5 in the numerator divided by 0.12. 5.5 divided by 0.12, we are getting 45.83. That is the price of the share. Rupees 45.83. So please use your calculators, everyone. As you can see, I am also using it till date. It is, that is the only way to get fast at it. So we have found out this market value as per Walter's model is done. Now we will answer the second subdivision. Now, here you see R is greater than KE. How do I know? 15% is greater than 12 percentage. I'm comparing these two. Okay. So when I compare these two, I'm getting R is greater than KE. That means optimum dividend payout is going to be 0 percentage. Very simple. R is what? IRR. So it is better to retain inside the company, because inside the company it will grow at 15 percentage. Outside it is growing at 12 percentage. So whenever R is greater than KE, internally it is better. So keep everything inside. Don't distribute any dividend. So dividend payout ratio means out of the earnings, how much dividend I am paying. Okay. So this is what it is. I hope everyone is able to understand this. Now we will proceed. So what we should write down in the exam? How should we write, ma'am? Point number 2, you write optimum dividend payout ratio is equal to 0 because R is greater than KE. Like that you should write down. Okay. Now, and they are saying at that payout ratio, please calculate the market value. So many people are stopping for this. No, they are asking if the dividend payout ratio is 0, calculate the price of the share. T0 is equal to D plus R divided by KE into E minus D. The whole divided by KE is the formula for Walter. Okay. Dividend payout ratio is 0 means D will be 0. So it is equal to 0 plus R is how much? 0.15. KE is how much? 0.12 given in the question. E is how much? We just now found out it is 5 rupees. Yes. Again, D is 0 because dividend payout ratio is 0. KE is 0.12. Now, please do this. 0.15 divided by 0.12 into 5. divided by 0.1. We'll get 52.08. So the price of the share will go up only when the dividend payout ratio is zero. It will be optimum. Okay. All right. So this is what the second subdivision is asking about. That also we have done. So now we will go to the next step. So dividend chapter also we have pretty much revised a good amount of things. So now we will do RSI. RSI means relative strength index. Okay. It is a past exam June question. Two times in June they have asked this. It is from the chapter security analysis. In security analysis, CAPM questions, funds flow statement questions, which we have done in the class. At least try to do one because all funds flow statement has not been asked recently at all. But still, you should know it. It's a professional exam. We don't know what question will come in the exam. So yes, it's advised that you know everything. So funds flow statement is a checklist in security analysis, FFS, CFS. CFS, of course, it is there in corporate accounting. We have done it in security analysis also because it is there in your textbook. Then we had to go through some ratios and then comparative and common size balance sheets or financial statements. Please do that. Okay, it's very simple, but please go through that. And then we have beta calculation. We did one problem wherein we did beta calculation. Then the last problem in the textbook. Then holding period return. Holding period return was also previously tested. So holding period return also, it is very simple. Yes, I know most of you in the test also you have done it correctly. So I didn't include a question in marathon. But holding period return means what? I am holding a share. What and all I will get out of the share? I will get what dividend plus P1 minus P0. That means price of the share at which I'm going to sell minus the price of the share at which I bought. Again, price of the share I'm going to sell minus price of the share I bought. Okay, divided by P0. So I will give you an example. This is the holding period return. Annualized return also we have done. Please go through the problem. Okay, HPR, holding period return. Now I bought a share. Say for example, I bought a share for rupees 60. Now the price of the share is equal to rupees 75. Dividend paid by the company is equal to rupees 5. Find HPR. That is the question. Okay. So now normally we will discuss what and all I gained by investing in the share. I gained 5 rupees dividend plus 75 is the worth of the share right now. If I sell it, how much profit I would have made? 75 minus 60, 15 rupees profit I would have made. Okay. So 5 rupees dividend I got plus 75 is the price of the share right now. Minus I paid 60 rupees for it. So 15 rupees I gained. So totally 20 rupees I gained divided by how much I had to invest 60. So holding period return, annualized return, how you have to do all this we have already discussed. So please go through this. It is also asked in the past exam. It is also checklist in security analysis. Okay. So now, other than the CAPM, some questions they have included. So other than that, of course, our theory. This is the checklist for security analysis. And we have RSI. Okay. So now RSI I will do. Okay. So RSI means it is nothing but relative strength index. It is many indices we use in the theory we have learned in security analysis, that we have multiple tools for understanding how the share is performing. Correct? Huh? In that, the relative strength is one of the things that we will be doing. Yes. 100 minus 100 divided by 1 plus RS. This is the formula. Yes. And RS means relative strength, which is equal to average gain per day divided by average loss per day. So please write this down. Again, all this should go to your formula page. In your formula page, ideally for security analysis, you should start from the format of FFS, format of CFS. If you want, you can write. And then comparative statement, common size statements, ratios, and then HPR, RSI, CAPM, all these should be there in the formula page. The day before the exam revision, there it should be there. Okay. So now, RSI of greater than 70 means it is overbought. RSI of less than 30 means oversold. So this also you should mention. Now we will do this problem and then we will start. Yes, you people have to help me out with the calculation. Yes, definitely. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, and 14. So first let me fill this. 4344, 4254, 4211, 4308, 4487, 4213, 4240, 4112, 4061, 4414, 4030, 4336, 4230, and 4392. Yes, so many are given. Okay. Now we will calculate the gain or loss. Okay. So you keep calculating. I'll join you all. Every day, whether we have gained or lost. That is what we are going to first calculate. Gain. So first day, nothing happened. Second day, we have lost 90. Okay. Third day, 43. Okay. Fifth day, it is a gain, 97. Okay. And then 179 is a gain. Okay. Then 274 is a loss. Okay. Then 27 is a gain. Okay. Then 128 is a loss. Then 51 is a loss. 353 is a gain. Okay. And then 384 is a loss. Okay. 306 gain, 106 lost, 162 gained. Okay. So now please calculate the total gain and total loss. Come on, students, please calculate the total gain and total loss. 1124 and 1076. Okay. 1124 and 1076. Okay. How many days we have gained? Let us see. 1, 2, 3, 4, 5, 6 times we have gained. So divided by 6. How many days we have lost? Because gain per day and loss per day, no? Yes, ma'am. That is only RS. So 1, 2, 3, 4, 5, 6, 7. 7 days. So divided by 7. So let us do this. So gain or loss per day. It is going to be 1124 divided by 6, that is 187.33. 1076 divided by 7, that is going to be 153.71. So RS, relative strength, is equal to average gain per day divided by loss per day. So average gain per day divided by average loss per day. So it is equal to 187.33 divided by 153.71. So we will get 1.22 roughly. Okay, that is the RS. So now we will go and do our RSI calculation. So RSI is equal to 100 minus 100 divided by 1 plus RS. So it is going to be 100 minus 100 divided by 1 plus 1.22. So we are getting 54.95. So this is the RSI, relative strength index. It is lesser than, yes, 70. So that means it is not overbought. It is not overbought. Less than 70. So over RSI. So I told you the concept of holding period return also. With the concept that I explained, please go. So the last chapter, that is operational approach, the most easiest chapter. That is why the questions are also less frequently asked. So can definitely, it may come, and it comes means it is a good cakewalk operational approach. It's easier than dividend decisions also. So if you have found it to be difficult up to now, please wait and stay tuned. So now, PVR is going to be what? So what are the formulas? First of all, let me tell you what are the formula checklists that you should do for operational approach. First, marginal cost sheet. Second is going to be profit volume ratio. Next is going to be BEP. There is one fly which has been flying here and there. Okay. So BEP, then MOS, then desired profit, desired sales. Okay. So these are the main things. Okay. So I will start from marginal cost sheet. In regular classes, I derive and show BEP and all that, but now we don't have the time for all it. So I'll just get you through how to make it easy. Marginal cost sheet. We will start with sales. Sales is what? Number of units sold into selling price minus variable cost. What is variable cost? Variable cost is also number of units sold into variable cost per unit. That will give me what? Contribution minus fixed cost. Less fixed cost will give me what? Profit. This profit is only EBIT. Okay. So this is the marginal cost sheet. So if you know this, you can tackle most of the things. And variable cost per unit will remain same. Total fixed cost will remain same. If you didn't know this, please write it down. I'll give you an example. So, what are the examples for fixed cost? Rent, depreciation. So, some students ask me who are not in the regular class, they ask me that, ma'am, rent keeps increasing year after year, no? Why are you calling it as a fixed cost? What is our definition of fixed cost? If you're new to the topic, you please write as and when I say. Fixed cost is the cost that does not change with the level or volume of output. Once again, I'm repeating. Fixed cost is the cost that does not change with the level or volume of output. What is the meaning of that? Now, say for example, fixed cost is going to be Rent. Okay. Now I'm talking about rent. We are running a cafe. Okay. Whether 1,000 people come to the cafe or even no one has come to the cafe, I have to pay rent to the building. Yes or no? Irrespective of the level or volume of output, how many ever coffees I sold, irrespective of that, fixed cost will remain the same. We are talking about total fixed cost. Ma'am, iದೇನದು total fixed cost ಅಂದ್ರೆ ಏನು? Now you're doing business separately. You have to pay 1 lakh for the cafe as rent. 1 lakh is the cafe's rent. Your friend is joining you. We have Madhumita who's doing business. Siri is joining her. Okay. Siri is joining Madhumita. Okay. So now the fixed cost per unit will become what? 50,000. 1 lakh divided by 2, 50,000. Total fixed cost. How much we pay to the landlord? That is 1 lakh. Ma'am, it will increase after 1 year, no problem. What is our definition? It does not change with the level or volume of output. WDV, ma'am, it is changing. How you're calling depreciation as a fixed cost. It is not changing with the respect of level or volume of output. How many ever coffees I sell, depreciation will not change. So that is the thing. Variable cost for the same cafe. Milk we are purchasing. Okay. One half a liter packet is 25 rupees, our Nandini packet. Okay. Will that change? No. Variable cost per unit will remain the same. If I buy 50 packets also, it is 25 rupees. If I buy 100 packets also, one packet will be 25 rupees. We are not talking about discount here. Okay. So this is what is variable cost per unit is remaining the same and total fixed cost will remain the same. I think now it is very clear. Okay. Now PVR, profit volume ratio. Profit volume ratio is equal to what? Contribution divided by sales into 100. See, contribution is also profit only, no? So many decision making purposes, we will use contribution. Okay. Then another formula for PVR is change in profit divided by change in sales into 100. Depending on what's given in the question, accordingly, you will choose which formula to use. Okay. Then BEP, break even point. Many people are saying no profit, no loss. That is only BEP. What is the right way of saying what is break even point? It is the level of sales at which the profit is equal to zero, at which there is no profit, no loss. It is the level of sales at which there is no profit, no loss. BEP in units, it is equal to fixed cost divided by contribution per unit. BEP in value is going to be fixed cost divided by PVR. So if they're asking BEP in units, you will use this, otherwise this. So regular class, we derive all this, but now I'm just going forward. MOS, margin of safety in units is going to be what? Profit divided by contribution per unit. MOS in value is going to be what? Profit divided by PVR. And then I would like to say here, cash break-even point also you can include in your checklist. We have subtracted depreciation. There is one question in the textbook, cash break-even point. Fixed cost minus depreciation. I hope you all remember. So please write that down in your checklist. Total sales is equal to BEP sales plus MOS sales. BEP sales plus MOS sales. Anything over and above BEP is equal to MOS, margin of safety. Yes. So this also is done. Desired sales is equal to fixed cost plus desired profit divided by contribution per unit. If we need in units, if we need in value, desired sales in value is going to be what? Fixed cost plus desired profit divided by PVR. So, ma'am, what is this desired sales and what is this desired profit? Suppose they give in the question, this much is the profit that I need. If they have given the profit that is required in the question, please use this formula. Same way, if they have given this is the sales that I need, how much profit I should make, then also you can use this formula. So whenever the question says this is the profit I want or this is the sales I want, you can go ahead and use these formulas based on whether they have asked in units or in value. Whenever in confusion, you can do both. But mostly the question may be specific. Okay, sure. So these are the formulas that you need to like really note down. Now, so now so the company produces a single product and it sells at rupees 200 each. The variable cost is 120 and fixed cost is 96. Find out the PV ratio. Okay. So I will do it here because we have all the information here. PV ratio is equal to contribution divided by sales into 100. What is the contribution? See, students, you can do it per unit also because it is easier. Yes, what is the problem here? No problem. So, can I say contribution is equal to sales minus variable cost? Yes, we can say that because just now we saw the marginal cost sheet format, which hopefully all of you must have noted down. Sales is how much? 200 minus variable cost is 120. That means 80 is the contribution divided by sales. Sales is equal to 200. So in that way, 80 divided by 200, how much are we getting? 40% is the PV ratio. 40% is the PV ratio. Okay. So sales at break even. Sales at break even. That also we will find out. That means break even point sales. That's all. BEP in, they are asking BEP sales. That's all. Okay. So now we will proceed to what is the BEP? uh, the formula. Let us recall. Yes, dears, very good. BP is equal to fixed cost divided by contribution per unit, or it is going to be fixed cost divided by PVR. Here we will do both. Fixed cost is going to be 96,000 given in the question. Divided by contribution per unit is how much? 200 minus 120, 80. So then here fixed cost is again 96,000. Just now we did PVR was 40 percentage. So let us do both. 96,000 divided by 80. That means 1,200 units is the BEP. When you sell 1,200 units, you are able to reach a profit of zero. Okay. So 96,000 divided by 40 percentage. Rupees 2,40,000 is the BEP sales. When my value is 2,40,000 sales, then I will get a profit of zero. So this we have done. Okay. So now sales units required to earn a target net profit of 1,20,000. Let us do that also. There's one insect which is going on flying around. So now we will proceed to sales required to earn a profit of 1,20,000. They have told the desired profit. They are desiring a profit of 1,20,000. They have given the desired profit in the question. So ಏನ್ ಮಾಡ್ಬೇಕು ಈಗ? Desired sales units they have given. Desired sales units is going to be fixed cost plus desired profit divided by contribution per unit. Okay. So now fixed cost is 96,000 plus desired profit is 1,20,000 divided by contribution per unit. Already we know 200 minus 120, that is 80. So 200 minus 120, 80. 96,000 divided by 1 plus 1,20,000 divided by, yes. Are we getting 2,700 units? That is the desired sales. That is the third one. Quickly write it down. So now this is also done. Now they are asking what is the profit if the sales is given. That means desired sales is given. That time also we can use this formula. But ma'am, I forgot this formula. Means even if you forgot the formula, if you remember the marginal cost sheet, you can still get back to the answer. So it is going to be desired sales in value because they're asking for profit is equal to uh, fixed cost plus desired profit divided by PVR. Okay, desired sales value they have given in the question. The sales is 7 lakhs. So I will substitute the LHS is 7 lakhs is equal to fixed cost is 96,000. I will keep desired profit as it is divided by PVR. Just now we found out it was 40 percentage. So when we cross multiply, what will happen? 7 lakhs into 40 percentage is equal to 96,000 plus desired profit. So in that case, yes, ma'am. 2,80,000 minus 96,000. So 1,84,000 is the desired profit. So this also we have done. So this question is over. Many students requested that this topic we will do less problems because you have other subjects to study given that we are actually very close to the exam. So what we will do is we'll do only few problems. We'll do only two problems in this. If time permits, you can try the ninth problem also, but it's not that important or anything. Normally, whatever is given in your textbook, whatever we have done in the class, for all topics, that is more than sufficient, along with the theory notes that I have given. And the marathon will take you to the conceptual clarity next level. That's all. So now we will proceed. I'll give you some tips towards the end also. So Zen and company has made sales for this much and the net profit is given to be this. Fixed overheads are this much. Find out the PV ratio, sales needed, net profit, BP. Okay. Okay. Now let us see how we need to do PV ratio. Okay. So they have given so many things. So can I say I will do the marginal cost sheet? Marginal cost sheet. Sales is given to be 25 lakhs. Then we don't know the variable cost. We don't know the contribution, but we know the fixed cost. Fixed overheads, fixed cost is all one and the same. It is 3,75,000 given in the question. Last one. Profit is also given in the question. This is 3,75,000, 25 lakhs, 2,50,000. So now what we will do is, again, reverse method. From profit and fixed cost, we can find out contribution. So number it that way for your own understanding. 2,50,000 plus 3,75,000 is how much, students? Yes, ma. 7,25,000. So number it this way. Okay. So now PV ratio is what? PV ratio is equal to contribution divided by sales into 100. Contribution is 7,25,000 divided by sales is going to be 25 lakhs. 7,25,000 divided by 25 lakhs is going to be 29 percentage. Okay. Please do it, students. Quick. Then we need to go to the next one also. Should I check that? Okay. 7,25,000 divided by 25 lakhs. The 6,25,000. Oh my God. I'm 6,25,000. Sorry. And thank you. 6,25,000. 25 percentage. Thank you. 25 percentage. Okay. This is also done. Now, sales needed to generate a profit of 3,75,000. Now, we will do that. So, this is done. Sales needed to generate a profit of this much. So, desired sales, whenever they have given profit in the question, we can use this formula. Desired sales in units is going to be what, students? It is going to be fixed cost plus desired profit divided by contribution per unit. Then desired sales in value is going to be what? Fixed cost plus desired profit divided by PVR. So let us do this. Fixed cost is how much? Fixed cost is 3,75,000. Desired profit is how much? 3,75,000. They have not given contribution per unit, so I can't do this. Okay, I can't do this. So now fixed cost is going to be 3,75,000. In the previous question, we could do both. Wherever we are able to do both, please do both to avoid any confusion. Unless and otherwise, the question is specific. So the PVR is how much? Just now we found it was 25 percentage. So it is 25 percentage. So 3,75,000 into 2 divided by 25 percentage, we are getting 30 lakhs. So desired sales is equal to rupees 30 lakhs. That is the answer for the second subdivision. Now, they have given the sales, whether they are giving profit or sales, we can use this formula. I already told you. So let us use this formula. So second subdivision is over. That is 30 lakhs. Third subdivision, yeah, they are asking what is the profit by giving the sales value. So I will substitute the LHS. The desired sales is 37 lakh 50,000 is equal to fixed cost is 3 lakh 75,000 plus desired profit. I will keep it as it is. That is what is our answer divided by PVR. Just now we calculated for the first subdivision, that is 25 percentage. Now we will do cross multiplication. 37 lakh 50,000 into 25 percentage is equal to 3 lakh 75,000 plus desired profit. So 37 lakh 50,000 into 25 percentage minus 3 lakh 75,000. That is going to be 56 lakh, sorry, 5 lakh 62,500. That is going to be the desired profit. So this is also done. Now we will do the BEP. This is the third subdivision answer is 5 lakh 60 rupees, 5 lakh 62,500 is the third subdivision answer. Break even point in units, if I have to do, what is the formula? Fixed cost divided by contribution per unit. Are we having this information? No. So I will do break even point in value. If it both are given, please do both. Okay. Fixed cost divided by PVR. Fixed cost is given in the question to be 3,75,000 given in the first few lines divided by PVR. We already know it is 25 percentage. 15 lakhs. Rupees 15 lakhs is the BEP. That's all. This is also done. So with this, we have come to the conclusion of this also. That is, we have come to conclusion of this chapter also. So now, how to prepare for FM? Okay. So first of all, be calm. And if you're finding some topic to be difficult in FM, first you try to understand how important that is. Are you finding security analysis to be very difficult? Are you finding working capital management to be difficult? Of course, regular students, I can understand that FM is very easy for you all. Yes, and past exam also, many students FM they have done very well. All this is okay. I'm talking about students who have not attended the regular class. So what you can do is FM theory. Please do bank on it. Okay, with the theory notes that I have given. Or those of you who are watching it in YouTube, the people can definitely get in touch with us for any assistance that is required. So bank on the theory. Okay. When I say bank on theory, you cannot leave it to God. Okay. So you have to prepare CA and FM equally important. Because corporate accounting, when I say CA and FM, corporate accounting, so assume it is a little bit difficult, then FM will be a little bit easier. If FM is a little bit difficult, then corporate accounting will be a little bit, you know, uh, easier. So what I'm trying to communicate here is you cannot just say that, okay, I'm not like good in this subject. No. Okay. You have to bank on your strengths. As I told you, this is a subject. FM is a subject which opens up many career opportunities for us. And you can also choose your electives in your professional paper. If you're very strong in this paper, you can choose your electives accordingly in your professional course. So what I'm trying to communicate here is you cannot like say it is difficult, so you have to work on your weakness where you're like really weak. Try to do more problems or get conceptual clarity more than doing more problems. The first step should be like you have to get the conceptual clarity done. So once the concepts are clear, any number of problems will look simple to you. So again, stick to one book, one material, and do that problem really well. Revise as much as you can. Okay. So when I say revise again, don't just read it. FM and corporate accounting both are subjects where you cannot read. Okay. So, and it also depends on the comfort level of the child. So if anyone has asked me, I love both corporate accounting and financial management. But FM is one step more higher for me. I like FM even more than corporate accounting. So it depends on your choice as to whether you have to, bank on corporate accounting or FM. That is all your choice. But you can never leave anything. Okay. Having said what is your strength, you're working on your strength, but still you cannot leave anything. Every single chapter and day before the exam, what you are going to revise, it should be very clear for you. So we have made a checklist for every single topic. So please check them out. Okay. The day before the exam. So if you're writing both groups, obviously your time will be lesser. Accordingly, you please give your time for the subject. Okay. So all the very best. Looking forward to see you in the professional course. So please do really well. All the best. Keep practicing. Let me know if you have any questions. Bye. Bye, everyone. Online students, please post us in the comment section if you have any questions. And please do find the PDF attached in the description box that is given below.